exception here is Asia, where the Asia region is catching up pretty fast, up to an extent because of the very high share of re-exports in the Asian economy and the very fast growth of China and India. We are discussing some estimates on the growth impact of this increasing intra-European trade, and we're estimating that it has contributed to about faster economic growth on average by about 0.3% annually for the European countries. The second chart shows one of the many indicators that measure financial market integration, and here we see that because of financial market integration, cross-country dispersion of equity premiums has been falling in the last 10 years. And this process is primarily what is driving convergence in emerging Europe. Through financial market integration, emerging Europe is able to finance its convergence. In the report, we are also discussing labor market integration, but this, although it has been increasing in recent years, it's still at a much smaller scale than trade or financial market integration. Now, these were the good news. What are the bad news? The bad news is that this convergence process of emerging Europe has built external imbalances. And you're very familiar with this point here in Croatia, and we at the IMF have been discussing this issue in recent years in our staff reports for the Croatian economy. Basically, emerging Europe is financing its convergence by borrowing abroad. Emerging Europe consumes and invests more than it produces. And in the first graph, you see that the result of this is very high current account deficits. Although Europe as a whole has a balanced current account deficit, and advanced European economies have a balanced current account deficit, emerging European economies, most of them have very high current account deficits, including Croatia that you see in this line here, the thick line. New EU member countries, non-EU member countries. The only emerging European economy with a surplus is Russia because of oil. 10 emerging European economies, primarily in the Baltics, have a current account deficit more than 15% of GDP. Latvia has 22% of GDP. Now, these ratios are much higher than ratios that we had seen in other emerging economies outside Europe before a crisis. Mexico in 94, East Asia 97, 98, Argentina in 2001. So it is definitely an external vulnerability. In the second chart, you see that the result of this is very high levels of external debt. And you see that the average in low and middle income economies outside Europe is about 25%. Most of the emerging European economies have already borrowed much more than this. And Croatia is about at 85%. Hungary, Estonia, and Latvia are much higher than this. Latvia actually is more than 100% of GDP. Now, this is a concern because such high level of external debt implies vulnerabilities in case there are large movements in exchange rates or large movements in interest rates, because almost all of this debt is in variable interest rates. Now, a question that we get a lot is that is East Europe today what East Asia used to be in the late 90s? So can we have a crisis? And I know that there was a recent IMF working paper that caused a lot of controversy here in Croatia, and perhaps it expressed a very pessimistic view, the half-empty glass point of view of this question. Our position is that although these are vulnerabilities that policymakers should not ignore, East Europe is different than what East Asia was back then in the late 90s. And for a number of reasons, but the most important reasons is that the most important reasons is first that there are no hot money involved in emerging Europe. Most of this borrowing has been channeled through the banking sector. The second is that this is driven primarily by expectations of EU membership and Euro adoptions at the end, and the impact that this will have in the economies. And the market expectations are positive because they expect that this will drive reforms and economic stability, but also they expect that this EU membership excludes extreme outcomes. You cannot have a leader like Chavez in Venezuela, for example, taking over a European country and moving in a completely wrong direction. And in a way, the markets reward this process. Having said that, it doesn't mean that bank lending is absolutely safe. and you see what happened with the subprime mortgage crisis in the United States. So these are vulnerabilities. East Europe might be different, but these are vulnerabilities that definitely we cannot ignore. In the report, we are looking at monetary conditions, because when there are concerns that the economy is overheating, when there are high external imbalances, you'll expect the central bank to intervene and try to cool the economy down. And indeed, in many emerging European economies, including in Croatia, you have seen the central banks trying to increase interest rates, trying to increase borrowing costs, introducing different measures in order to limit external borrowing and slow down credit growth. And what we look at this graph is to try to see if this tightening in emerging Europe has actually tightened monetary conditions in practice. And we look at a number of measures. In red color, you see the euro area lending rate, which, given that these economies are very open, this is the relevant lending interest rate. And then we look at a monetary condition index, which takes into account lending costs and exchange rate developments, and lending interest rate minus Taylor rule interest rates, which in a way takes into account what the interest rates should have been taken into account, output gaps and the overheating of the economy and inflation pressure and expected inflation. And what we see basically after 2003, this is the average for all emerging European economies. Monetary conditions in emerging Europe have been loosening, despite tightening measures by the central bank. And this actually proves a point that even the central bank here has emphasized a number of times, that the only thing that the central banks can do in these economies is to lean against the wind and only have a supportive role. Given that these economies are very open, quite often, as is the case in Croatia, they have either pegged or tightly managed exchange rate systems. There is very little that the central bank can do. In practice, this is what we're seeing. The monetary conditions are loosening, which is consistent with very fast credit growth in emerging Europe in recent years. Now, with this on the outlook, let me move to the recent financial market turbulence, which is an important risk going forward, and definitely needs to dissipate in order to validate the baseline scenario. Now, I'm sure you have heard about about foreclosures of houses in the United States, interbank money market having a roller coaster ride, injections of liquidity by the central bank, some financial institutions like Northern Rock in England getting into trouble. In very simple terms, what actually happened in this shock, and we're still actually analyzing it because it is still very much underway, is financial innovation moved much faster than risk management in the private sector and financial regulation. And this resulted in a number of gaps that caused the current crisis. Very briefly, the gaps were the following. First, because of very fast credit expansion in the United States, at some point credit standards were loosened, credit standards were relaxed. So new credit was not quality credit. And the market expanded in what we call subprime debt, which in normal circumstances they would have never done it. Subprime debt expanded basically in the last 2 to 3 years in the United States. Now, the way the banks were extending this credit, usually banks in the United States, they will have loan-to-value ratios, they will have debt service to income ratios in order not to take excessive risks. All these were relaxed. And they were giving these loans, and then they were securitizing, they were packaging all these loans, and they were selling the risk. Now, because they were selling the risk, there was not incentive for them to be careful, basically. So they were not as cautious as one would expect. So one failure of the system is here. The second failure of the system is that who was buying this asset? They were setting up the so-called structured investment vehicles or other organizations or vehicles that were buying this and then they were selling them. Now, these were off-balance sheet items, so directly they were not affecting the banks. However, many of them, about 90% of them, had guarantees from the same banks that they will have credit in case they need financing. So although the banks from the one door were getting rid of the risk, from the other door they were getting it back. And even though the structured investment vehicles that they did not have such guarantees, because they were linked to the banks, there was reputational risk. So there was an implicit guarantee. So the second failure of the system is here. The third failure of the system is that these structured investment vehicles, then they were selling these instruments to investors in the market, primarily money market funds. Now, money market funds are usually very risk-averse investors. They were buying all these titles based on ratings from the rating agencies. And the rating agencies were giving very good